Silicon Valley Bank has collapsed and federal regulators have taken control.
Try and thin any sort of contagion effect.
Impacting tech startups, leaving customers in limbo.
Raising concerns about the broader economy.
If we hadn't been driving our economy with easy money and then trying to really quickly undo that, we wouldn't be having these problems now.
Hello, welcome to this special episode between Independence Money. I'm Nathan Wilson, a certified tax specialist, and Rob Kientz with Gold and Silver Pros. This is a little different than previous videos we've done on our respective YouTube channels, but I think you guys are going to really like it. It's a documentary on the age of easy money, a little bit of historical references on how we got into this problem, and what you can expect going into this new age in our future.
Awesome. Look forward to it.
Well, thanks for joining us, Rob. You got a chance to watch this video, didn't you?
I did, and it's a really good expose on the history of money in the United States, specifically around the dollar era and how it came into place and the factors that affected it, and also how that era is sort of played out. And I think there are a lot of revelations in the video that people maybe now are just waking up to, as we've had recent bank failures and things. And I think people will be maybe more receptive to this now than they would have been 5 or 10 years ago, prior to the last recession and what we've seen lately. So I think it's a really good documentary put out by PBS. I think it's got a lot of good points that we're going to go through.
Americans can rest assured that our banking system is safe.
In a special frontline investigation,
we're now facing a world of many potential outcomes.
The inside story of an age of easy money.
Every financial function had failed, and we had to restore them.
Did you think it was a radical policy?
I most certainly did think it was a radical policy.
The Fed inject money into the economy, fueled by recent government stimulus programs.
When the Fed changes to the primary engine of economic growth, it's supposed to be our democratic institutions that do that, not the central bank.
Yeah, I agree. And I appreciate you sharing your personal experience during that 08, through 10 period. Mine was, if I can share it a little bit, it was a different situation. I had kind of more or less just left corporate and started a finance company in 2007. So yeah, start a finance company in 07 before 08. It was remarkably lucky timing, right? But the other thing was relying on old world strategies. So my dad had given me this book, by Dave Ramsey about, pay off your house. And so I had a fixed mortgage. It was a 15-year mortgage. It was fixed. And like he coached, I was overpaying on it. So I only had 5 years left on my house and about $200,000 worth of equity in that house. And then, my business wasn't doing well. It was 08. And although I had good credit and I had great equity in my house, I learned firsthand, you can't get liquidity out of a house if they're not lending. So that 200 grand of equity was worthless to me. And that's where I kind of really learned paying off your house could put you in a liquidity trap if you don't have that other liquidity. So now, fast forward to now, I definitely make sure I have that liquidity just in traditional checking, but also in gold and silver is another big element of my personal plan. And then I've developed a triple tax protected strategy where the principal is guaranteed, it's tax-free, and I can get about 90% of that account liquid within about 2 to 3 days. Because I'm kind of like you, I'm bracing for this storm that's coming. I don't think this is going to be a simple hiccup, a normal little market correction like we saw in 2020 where, the Fed injects money and it just comes right back. I think this is a big macroeconomic paradigm shift.
Throughout 2022, the economy remained strong. Unemployment hovered near historic lows.
Showing unemployment at a half-century low.
Wages were on the rise.
We also saw some wage growth, about 5% annually,
causing the Fed to continue pumping the brakes to try to cool down inflation.
The Fed has been raising rates in hopes of slowing the economy. And with so many businesses still hiring, that means the economy isn't really slowing that quickly.
That riled Wall Street.
Facing the growing possibility of a recession, Wall Street spent another day in turmoil.
And you're probably feeling it in those 401ks. Stocks are...
For the stock market and bond market, it was the worst year since the great financial crisis in 2008.
The NASDAQ down for 4 straight quarters for the first time since the dot-com bust.
In 2022, We've had this very unusual situation whereby you've made double-digit losses on both risky assets, stocks, and risk-free assets, US Treasuries. That's not supposed to happen. But there's been absolutely nowhere to hide. That is a big issue for retirement plans, pension systems. No matter how well you diversified your portfolio, there was no risk mitigation in it at all.
It was all losses.
It was all losses.
Yeah, things never happen as fast as we think. It's a slow process, and that's a great segue. So, I mean, I think really from, the first point I want to make on how people can prepare is this is a macroeconomic shift. This could be a once in your lifetime shift. The main thing I want to stress right now is what the next 15 years looks like is going to be nothing like the last 15 years, where you could put money in your 401k and put it in high growth stocks that don't even turn a profit. And those stocks just go to the moon and make you feel rich. And you could buy a house you can't afford and the value of that house goes up and makes you feel rich. And you could buy whatever you want because why not? You're not earning any money and you're checking your savings. Why save? Why not spend? I think that's all going to change. I think we're going to have to get used to a world where more likely than not, we're going to have higher interest rates, which I think is good. It rewards the saver. It helps those that have invested in the right things, not debt-laden companies like I mentioned, and it slows down consumption and especially excess consumption. So I think that could be a good thing. But I think realizing we're living in a different world and it's not going to be the same thing that you did over the last 15 years is going to work. I think that's step number one that the viewers need to embrace. We go through another banking crisis or lending crisis, that liquidity could disappear or dry up or be inaccessible overnight. On the same token, I see the vast majority of investors and baby boomers especially have the largest percentage of their net worth outside of their home in their 401ks. Well, that could not be liquid as well because it's got a 59.5 rule on it. A lot of times that money is tax deferred, so getting access to it could trigger taxes. A lot of times it's tied to your employment, meaning it may not even be really yours to invest as you want while you're still employed at that job. And although it's a great wealth building engine, again, you have to prepare for the next shock to the system by having a certain amount of liquidity that you can get access to. And I think maybe that in the age we're living in, Rob, that may or may not be just keeping it in the bank.
Yeah, there are all sorts of risks with traditional stock and bank accounts. Not that I would discourage anybody from having them. Everybody's got to make their own decisions. But the problem you're going to have with like a 401k account is not only you're captured till 59.5, or you have to pay the penalty and pull forward your tax because it's a tax deferred investment. So you're going to pay tax one way or the other. And as soon as you redeem it, you can take loans off it, but you owe it back to yourself. It just creates a liability on your balance sheet. So if you're looking for liquidity, borrowing from a 401k actually may not help you because yes, you get the money, but then you have to pay it back almost immediately with interest. And it creates a bigger liability than the one you were dealing with before. So unless you're getting out of a quick jam, borrowing from your 401k, a lot of times it's not the best idea. A lot of times it puts you in worse financial position than you would have been otherwise. But also, getting the money out and using it can be very difficult. And the 401ks are typically invested in things that aren't doing as well since, about a year and a half ago. For about the last year and a half, the stocks and bonds you typically invest in 401k aren't doing as well. And so now I've had a lot of people saying, I want to get out of my 401k and I want to get into precious metals or something like that. So people are starting to think about, it's not just the vehicle you're in. It's great to have a 401k and get that company match. But if that's not a safe vehicle or it's not providing liquidity or the assurance that you need, it may be time to look at a different type of vehicle. And it's not only the vehicle, but it's what's in the vehicle. So just saying a 401k really means nothing. It's like, okay, you got a 401k. In general, I know that you're putting money into funds, your employer's going to match. Great. What are you putting your money into? That becomes really the second question and probably the more important one. The vehicle is great from a 401k, but if you're putting it in, it's losing 30% a year and they're only matching you 6%, you're losing money. So the match doesn't matter when that investment's losing money. And I think that's what happened last year. I had a lot of friends come to me and say, my 401k lost way more than what I got as a match. And I'm still ahead because you add up all those matches from previous years. But If I have another couple of years like that, I'm back to where I started 10 years ago, you know, and after 10 years of not making money, and that's the thing that we have to pay attention to. All assets move in cycles. Stocks and bonds move in cycles. So do precious metals. So do any, you know, real estate, any type of investment. And just being in a long dated investment, a 401k and IRA, without paying attention to the underlying vehicle, a lot of times can cause you the most risk or to your portfolio and the most losses. And I learned that in 2000. I was invested in Janus funds that were considered the longest running, the most stable fund in 2000 at the time. I lost 40% in the span of like 3 months. And what was considered the longest running, most successful ETF fund family, I lost 40% during that crisis. I learned right then, it's not always good to put your money and hold it a long time, even in a reputable fund, because there are cycles. And that's where I learned about cycles. And so it's the type of investment and what you're investing in that you really have to pay attention to. And I think Americans have gotten away from that. They've gotten away from paying attention to what their money's going into. Well, now doesn't it make sense to pay attention to what your money's going into? If you're investing in corporate America and corporate America can't pay its bills, do you still want to be invested in corporate America? It may be where you have a certain amount of investment in corporate America, but you don't want to risk it all. And you want to look at other vehicles that give you other options. And those are the types of things that people really need to do sort of on an every year basis, but really like on a monthly basis. You need to go back and revisit your portfolio and say, the assumptions that I made when I put this together, are they the same? Is the environment the same? And again, going into a long dated IRA or 401k with your employer is sort of the antithesis of that. Is sort of put it in and forget, but you have those asset cycles, which damages your portfolio over time. So what I always advocate for people is look at the vehicle, look at what you're investing in, and pay attention to the cycles, and don't just assume it's going to do well today. It's going to do well 10 to 20 years from now.
U.S. existing home sales plunged to a 12-year low in December.
You've seen a huge impact on the housing market.
The Federal Reserve's interest rate hiking cycle has pushed down.
Housing prices have started actually coming down for the first time in a very long time. Mortgage applications have decreased. The crypto market, you've seen a number of companies wiped out.
Crypto winter is here.
That is not unrelated to what's happened with the Fed.
Sam, hold on to me, Sam. Let's go.
Sam Bankman-Fried faces investigations from U.S. regulators and potentially the Department of Justice.
He invested $3 million into Luna, and now it's worth 1,000.
You create these asset bubbles. That is, bubbles in stock markets and bond markets and real estate markets and art markets, whatever people invest their money in with borrowed money. And then those bubbles burst, and then that causes a downturn. So
Stephen Pearlstein has been reporting on the financial markets and the economy for almost 40 years.
That look like that. Bubbles tend to be everything bubbles these days, because if the source of it is cheap money, then you can be pretty much sure that it's not just real estate, or it's not just stocks, or it's not just tech and telecom, or it's not just Bitcoin. These things are connected by rubber bands with each other in a sort of way, and what propels one propels all of them.
I actually help out people, you know, with tax strategies and asset protection and diversification as well. If you want to reach out to me, a team at independence-money.com. But talking of cycles, you know, I think we're going into a tailwind for commodities and especially precious metals. Mm-hmm. But in all cycles, precious metals offers diversification to the rest of your assets. And I've had viewers reach out to me, and it just breaks my heart. You know, they're like, I busted my IRA or my 401k and paid a bunch of penalties and taxes because I really want to get into precious metals. And I'm like, I wish we would have talked first, because under the rules, if you follow the rules correctly, you can buy precious metals, gold and silver. I'm not talking an ETF or a mutual fund. I'm talking physical bullion. You can buy those in a self-directed 401k, an IRA, and a Roth. And that's message number 2 I want to get across the viewers is you can diversify out of traditional investments if done properly, and keep it in the tax code that gives you that retirement protection, as well as you can buy real estate and international. I mean, I know with low interest rates, I think the entire United States is in a real estate bubble. And I found some good diversification real estate options in Central America for a few reasons. One, it's not been a bubble down there. 2, they don't have the lending down there. So a lot of these people are having to save up, for years or a decade, or pool family resources together to buy something in cash, that means that they value that property, they're going to take care of that property, and the prices aren't going to be sky high because people are having to buy in cash instead of leverage. And then again, I think, macro changes. We're having a decline in birth rates. I mean, this has been going on for a couple of decades. And I think there was a recent statistic, Rob, where even less millennials are wanting to have a baby because they're scared of the future, where in Latin America, they have a lot more of a working force of younger generations, and that's going to fuel their economy, as well as the rental market and the purchase market. So I think there's other things that people need to look for under this macroeconomic shift. Now, again, not individual investment advice. These are just things that I've noticed and looked at myself.
Right. Yeah. We're not here to offer individual investment advice, but we do like to talk trends and we like to talk risk, because that's the type of information that can really help you in your own research and figuring out what your next steps are. And certainly, that's valuable information. I think a lot of what was in that documentary, a lot of what we talked about, are talking about those risks. And also, a lot of what we do in education is trying to help people with alternative solutions. Certainly, we mentioned the precious metals are big. There are other ways in which you can invest your money that protects the principal. It's completely legal, by the way. There's so much in the tax code to promote people putting their money in diversified assets. And if you contact somebody like Nathan, who's done this before, he can follow that program and that strategy to provide you some alternative investments that are completely legal and that are put there on purpose. They're there to incentivize certain types of behavior. That's what the tax code is. It incentivizes behavior that either provides people goods and services, housing, value. The tax code really is there for people that want to provide something for somebody else. So talking about real estate, where you're providing shelter service, it's a tax advantaged investment because we need shelter service. And so the IRS, of course, is going to support that in the tax code. And the way a lot of the tax code is written is to support investment that helps America build and progress. And some of those investments are the types of things that we're talking about, which will get some favorable potential tax treatment, but also diversify your portfolio at a time in which diversification is good. Because if you're sitting in all this stuff that's kind of blowing up right now, and you're just sitting there, you're just losing money every day. And instead, if you can get into things that have a better positive profile, provide you maybe some advantages from a tax perspective, but also from an investment perspective, and fit within those rules, then all of a sudden you've got a really good plan in place. And that's really what it's about. When you go into situations like that, it's about planning. It's about saying, okay, these are the risks that I see. What do I do to then plan out my portfolio the next 5 or 10 years to address some of those risks? So you can still be in some of your 401k and stock and investments, but you've mitigated that with some other moves that you're doing that may provide you, a better options and better overall outcomes going through this transition. And I think that's really the key, is to look at the transition and say, okay, what can I do to kind of prepare myself for what's coming?
Less than 5 months after that interview, the Fed would indeed have to step in.
In breaking news, the US Federal Reserve has bailed out the Silicon Valley Bank, which had collapsed over the weekend.
It enacted emergency measures to shore up the banking system after 2 banks collapsed.
This is the biggest bank collapse since the 2008 financial crisis.
There are important questions of how these banks got into the circumstance in the first place.
We're seeing a potential fragility in the system related to monetary policy. If we hadn't been driving our economy for 14 years with easy money and then trying to really quickly undo that, no, we wouldn't be having these problems now. Absolutely not.
What should the Fed do?
So for a long time, I've advocated that the Fed should be raising rates. But even I believe now they need to hit pause. They've gone too far, too fast. They need to hit pause and assess the impact on the financial system and the economy.
It's unclear what the Fed will do next, but just days before the bank failures, Jerome Powell appeared before Congress to answer tough questions about the economy.
We actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase?
The hearing was a showcase of partisan politics and government gridlock.
Raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending,
And it was yet another reminder of how, in an era of political dysfunction, we've become so dependent on the Fed and on easy money to drive the American economy.
The economy needs to get back into balance, and that will be painful. And if we keep putting off the day of reckoning, we'll just make the day of reckoning a bigger day of reckoning.
How do you think we'll look back at this era of easy money?
Unfortunately, I think we may look back on it as something of a golden era because, cheap and free money without consequences is great. But in other ways, we will think about it as a lesson for the future, which is that it was a mistake.
Yeah, and I think there's two more points I want to make for the viewers on this new shift we're going into. One, I want to talk about insurance companies versus bank, and then the final point we'll wrap up on is what's going to go on with taxes. But if you look at the insurance companies versus the banks, again, going back in history to the Great Depression, who bailed out the federal government as well as the banking system? It was the insurance companies. Mm-hmm. What is the third word in the acronym FDIC? Federal Deposit Insurance Corporation, right? Mm-hmm. Insurance companies are different from banks. One, they don't lend out all of their money, and their solvency is not dependent on those loans getting paid back by individuals and small businesses. Their liabilities are their death benefits, and their assets are what they buy to support those liabilities. And a good insurance company is fully capitalized, meaning if everybody died and they paid out all those death benefits, they should have more than adequate reserves to pay all those claims. So the solvency is better. The second point is insurance companies tend to do better in rising interest rates environments where banks tend to get squeezed more. So, if you're interested in a liquidity strategy that I personally use, a lot of my clients use as well, where you can have access to liquid money that's, unlike the 401k you talked about, Rob, you can properly structure it. You can have that liquidity. You can have principal protection. And my fourth point, you can have tax protection. And by the way, before we forget, Rob, there's going to be a jot form in the description here where you can tell us a little bit about yourself, whether you're interested in precious metals or other tax strategies or topics we've talked about. And between Rob and I, we'll work with you individually to kind of get those questions answered.
Yeah, and I just want to point out, the last time we went through this inflation deflation cycle, gold had been removed from its peg because, we were taken off of the gold standard. We had a free floating currency. And then a couple of years later, they established the gold in industrial trade markets here in the U.S., known as the COMEX and the NYMEX and all of those. And then gold was allowed to freely trade. At that point, it wasn't pegged, so it didn't have a set price. And it went up to 250 real quick, kind of came down, went to 400, stayed there. But once we started getting into the era of inflation in the 70s and 80s, gold quickly rose to 850. When gold rises during eras of inflation, it is the best inflation hedge, over a 5,000-year history. Silver is a little bit more speculative. It can be an inflation hedge, but much more. It's like a more leveraged, younger version of gold, maybe a little bit less stable, maybe younger and better looking and gives you better returns. But a little bit more frothy, if you will. But those metals tend to do really well during periods of inflation. And also during deflation, we have negative interest rates without going into that. So gold tends to do very well during the inflation deflation cycles that we're going into. So that definitely is an investment at which people may want to get interested in and think about adding to their portfolio as well. And a lot of that will be like capital preservation, value preservation, making sure that you're maintaining your lifestyle through tough economic times. It's the main thing. If you listen to Warren Buffett, what he says on investing, first rule is don't ever lose money. Second rule is read the first rule, right? So it's all about the number one thing should be wealth preservation, modest growth of capital, removing risk. And then you start to look at things like growth, but you also want to look at the practicalities of how do you protect yourself against liabilities and things like that. But gold can help in a lot of those ways, and so it could be part of any investment plan during any time and age, but specifically during times like this, gold tends to get really popular. Case in point, I've had people come to me in the last week. It's a hedge fund looking to buy a lot of gold, and they want $150 million of gold, and I'm trying to source $150 million of the gold, and it's actually pretty hard. There is gold out there, but in large quantities, it's not as liquid, and I've even gone to talk to miners about fresh supply and trying to secure this. So big money is moving into gold right now. So if you're looking at the precious metals, just know that that market is starting to get tight on the big end. You still, if you're retail, you still have time to get some gold. But if you're looking at any size, that's being taken off the market. And eventually what's going to happen is everybody's going to want to put gold in their portfolio. You've got pension funds, you've got 401ks that are going to want to do it. You've got wealthy family offices. You've got sovereigns that are buying gold, the central banks. So a lot of that gold demand is really getting strong right now. So if you are thinking about doing gold, now is really a good time to do it. But that should be a part of your overall balance strategy. So I recommend people fill out that informational form that's going to be attached to the video. And then, more information can be provided about different options.
Yeah, absolutely. I appreciate the insights on that. I mean, going back to before the age of easy money, it was very standard for money managers, pensions, and the like to have an allocation to precious metals. And then it kind of went down during the age of easy money. So I think from a macro historical standpoint, it would be more normal for somebody to have an allocation. I never believe in all or nothing. I don't think you should cash out of everything and buy any one asset. But having a percentage in there makes sense from an investment standpoint, and it doesn't have to be an apocalyptic scenario for you to get a great rate of return during certain unstable market conditions. So I think the fourth and final point I want to make is you always need to begin with the end in mind. And what I'm talking about here is taxes. So if you have real estate that's highly appreciated, whether it's your house or rental property, or you've really rode this bull market and your 401k and all of that money's been tax deferred, you're going to have to pay the piper at some point. We're going to have to address our national debt if we want to survive as a nation. In a higher interest rate environment, more and more of tax revenue is going to just meet interest on the national debt. And then they have a really short maturity on their portfolio of T-bills and bonds. And so as those mature, they're going to have to buy them back at a higher interest rate. All roads lead to higher taxes. It's unsustainable that we can run these deficits, give out all these entitlements, and keep taxes this low. So if a large percentage of your investments is tax deferred, either in traditional IRAs or 401ks, or an unrealized capital gain, you're sitting on a huge unrealized gain if you were to sell a real estate position, for example, now is the time to implement a tax strategy. And that's one of the things I say a lot is if your financial plan does not include a tax strategy, you don't have a financial plan. And that's really why I became a certified tax specialist, is because you really have to focus on that. And what I always like to say is if you have a financial plan that doesn't have a tax strategy, you just really don't have a financial plan. You've got to address the risk of higher taxes going forward.
Yeah, and that's, like I said, it's in the tax code. Those strategies, are there for you to use. It's just a matter of having somebody look at your individual situation and really understand how to apply those.
Awesome. Well, I certainly, from one nerd to another, appreciate getting to do this multi-part video series. I literally watched this 2-hour documentary twice. I was really kind of blown away that they exposed it like they did, because they literally pointed out all the flaws, and some of those formal federal chairmen, that are now hence retired, more or less stated like this in retrospect we thought would work, but in retrospect was a bad idea, and now we're going to have some problems going forward. So if you want to make the commitment, definitely watch it. But if not, I hope you got the highlights from this video here.
Yeah, it's a great documentary. They really did a good job and basically called out, all the obvious things. And it's always, hindsight's always 20/20. But the good news is, you still have time. So it's a good thing that came out, and we're doing the video on it, so people still have time to do something. You wait another 6 months, who knows whether that'll still be the case.
I think that we're going to look back on this era as being totally exceptional historically, and one where we didn't fulfill its potential. We lost sight of something critical. We lost sight of how we grow our economy in a sustainable and inclusive fashion. The world of easy money went way too far, way too far. Let's do the other stuff that's needed. the stuff that really promotes genuine, durable, inclusive growth, and not this stuff that creates artificial growth. We are capable of producing that. None of that is in the hands of the Fed. They don't invest in infrastructure. They can't reform the tax system. They can't help labor retraining. This is a political problem.